Hello, and welcome to part 3 of our 4-part series for the CRCS exam prep. We previously went over in part 1 the CRCS exam overview and tips for studying, as well as the federal agencies and regulations. In part 2, we went over the billing section of the book, and now we will discuss credit and collections. My name is Marina Hines, and I will be going over this section along with Andy Politz, who will join us later. The objectives in the study guide will identify the specific information you need to know for credit and collections to pass the exam. You will need to be able to define the terms related to credit and collections, explain how the statute of limitations affects collection efforts, identify elements of an effective collection policy, describe typical self-pay options along with the advantages and disadvantages of key options, identify common types of bankruptcy, how they affect the collection process and possible outcomes, identify the responsible party for a given scenario, define and list advantages of a courtesy discharge, list common delays and stalls of third-party payers, identify common debt collection methods and practices, list generally accepted accounting principles for the cashier's role, and describe common metrics related to collections. Some of the regulations that apply specifically to credit and collections we will go over. They were previously discussed in the federal regulations and agencies section in the part 1 series, but we will go over these here as well. So collections in the healthcare industry occurs when patients do not fully pay their financial obligations prior to or at time of service. Due to this, specific credit regulations apply to providers. The first regulation is the Telephone Consumer Protection Act, which restricts telephone solicitations and the use of automated telephone equipment. The TCPA prohibits the use of auto dialers without express consent when the phone number is a cell phone. The TCPA also limits the use of artificial or pre-recorded voice messages, SMS messages, and fax machines. The Truth in Lending Act, which is also known as Regulation D, deals with how information is disclosed prior to credit being extended. Under Regulation D, the APR and finance charges must be clearly and conspicuously identified, as well as written disclosures provided to the consumer. The Fair Credit Billing Act requires creditors to inform debtors of their rights and responsibilities of the creditor, whereas the Fair Credit Reporting Act defines what information from consumer reports can be used, by whom, and when. The Equal Credit Opportunity Act prohibits credit discrimination on the basis of race, color, religion, national origin, sex, marital status, age, or because someone receives public assistance. The Fair Debt Collection Practices Act was the result of debt collectors using abusive collection practices. The act imposes limitations to protect the debtor in communication and information being gathered. The act prohibits abuse as well as using misleading information while collecting a debt. Under the FDCPA, the collector cannot contact the debtor at any unusual time, which is defined before 8 a.m. and after 9 p.m., or at any time or place that is inconvenient to the consumer. If it is known the debtor has an attorney, the contact must be made with the attorney unless consent is previously given. If the collector knows the debtor's employee prohibits such calls, the collector is prohibited from contacting the consumer while the patient is at their place of employment. There are specific terms listed out and identified in the credit and collection section. Here are the definitions of those terms. So charity care is the first one identified, which is defined when a service is provided but never expected to result in cash flow. Charity care results from the provider's policy to provide services free of charge at a reduced rate to individuals who meet certain financial criteria. Indigent is defined as an individual who has no means of paying for services or treatments and is not eligible for public assistance. Bad debt is an uncollectible account resulting from the extension of credit. And the statute of limitations is the amount of time in which a claim must be collected before it is deemed paid or satisfied. No legal proceedings can be initiated after the statute of limitations expires. The statute of limitations can vary from state to state. They are typically less for open-end accounts or oral agreements, greater for notes or written agreements, and the greatest time for judgments. They may be extended if a written promise to pay is obtained, a partial payment on the principal account is obtained, a new contract is obtained, or the account is reduced to a judgment. Organizations should have written collection policies in place to ensure all staff follow the proper procedures. Several different processes and policies make up an effective collection policy. All processes of an organization play a role in the patient's service and, in result, the patient's final balance. Having effective policies in place can limit the amount of money due to the organization post-discharge, which could potentially limit the amount written off to bad debt. Here are some of the examples that should be a part of effective collection policy: the admission policy, the payment policy, follow-up, public relations, charity care requirements and protocols, discount policy, the practice of charging interest if applicable, contract amount implications, a bad debt policy, determination and verification of responsible parties, and process for handling errors and complaints. Offering payment options for self-pay balances can potentially obtain a partial payment for the payment in full prior to the date of service or discharge. While collecting money from the patient can help reduce the bad debt of the organization, there are advantages and disadvantages to these forms of payment. So some of those options are cash or check, credit cards, health savings accounts, credit union funds, cash from sale of assets, loan programs, money transfers, money orders, extended payment plans. The advantages for obtaining credit card payments specifically are immediate payments, options of payment plans, can receive payments over the phone, and the ability to get prior authorization to charge the card after the insurance payment. The disadvantages for credit cards are additional costs of processing credit cards, potentially more paperwork like deposit slips, potential public relations problems if patients object to paying interest on medical bills, and additional work to follow payment card industry regulations. Extended payment plans may also be offered if the other options are not feasible. The options for payment plans include 3 monthly installments, same as cash, and period payments with or without finance charges, and lowered payments now with a higher payment or balloon payment later. Finance charges can be applied, however, the provider must ensure the financing information is understood by the patient and the debt will be treated like any other financing agreement. Bankruptcy is a legal proceeding taken when the debts of an individual or company exceed the assets and is presumably no reasonable hope of repayment. This is handled by the U.S. court system within the state of residence. There are several types of bankruptcies. Chapter 7 applies to individuals and businesses that cannot pay their debts based on their income. Except for exempt property as defined by state laws, the debtor's assets are auctioned to satisfy creditor claims. Around 70% of all bankruptcy claims are filed under Chapter 7. Chapter 11 is frequently referred to as the reorganization of bankruptcy. This gives a distressed business a reprieve from creditor claims while it continues to function and works out a repayment plan. The business is given 3 months to draft an initial plan, and after that, anyone can submit a plan. Most Chapter 11 cases end up as Chapter 7 liquidation cases. An involuntary debt or bankruptcy is when a debtor can be placed involuntary under Chapter 7 or 11 if the debtor has 12 or more creditors, 3 of which have claims greater than $5,000 each and are willing to force the issue. If fewer than 12 creditors, then only one creditor owed at least $10,775 is needed to force the bankruptcy. Chapter 12, which is specifically designed for farmers and providers that only a family farmer with regular annual income may file the petition for relief. Relief under Chapter 12 is voluntary, and only the debtor can file the petition. Chapter 13 is designed for individuals who want to but are not currently able to pay their debts with regular income. There are 2 different court rulings when it comes to bankruptcy cases: a discharge or a dismissal. A discharge of debtor release the guarantor from financial responsibility of any and all account balances listed on the bankruptcy petition. Account balances are to be written off. So this is specific for when the account is actually listed in the the bankruptcy petition to make sure that it is listed. A dismissal is when the bankruptcy is rejected by the court. This is typically done when the debtor fails to follow through on the filing process, fails to provide requested documentation, and fails to pay the attorney. Once the bankruptcy is dismissed, a creditor can bill the debtor directly refer the account to a collection agency, or pursue litigation. There are several steps to take when receiving a bankruptcy notice. So when you receive a bankruptcy Chapter 7 notification, there are several steps we must take to follow. First, we have to flag the account, listing the chapter, court jurisdiction, legal counsel, and phone number. Then we need to suspend all collection efforts, pending the decision from the court. We need to cease all contact with the patient, demanding payment in full, notify any collection agencies handling the account, forward a copy of the notice to the agencies, and then notify all parties if any payments are received on the account. We need to follow those steps and keep that until we can stop collection efforts until we receive that dismissal or discharge. So to talk about the responsible part, determining the responsible party, and the remaining points of the credit and collection sections will be Andy Politz.
All right, thank you, Marina. Okay, so determining the responsible party. This is actually important in credit and collections because staff has to be able to determine who is ultimately going to be responsible for the account and who they need to be collecting from. So there's a few basic principles to follow when determining the responsible party. In the cases of adult patients, it is always themselves. Even in the case of negligence or a liability issue where another party is at fault, the adult patient themselves is still responsible in that scenario. It might be good to try to separate the ideas of responsibility and liability when thinking about this. So the adult patient will always be responsible for themselves. Next, in some states, spouses can be responsible for each other's debts that were incurred during the marriage. So that has to happen during the marriage, but it can follow along after the marriage ends or if the spouse dies. So just because there is a divorce or the spouse is deceased doesn't mean that responsibility necessarily goes away at that point. Okay, parents of minor children are both held responsible. And this is true whether they are still together or divorced. At this time, both of those parents are responsible as parents of a minor child. And for authorization for treatment in life-threatening emergencies, and when it's not required, when life-threatening treatment is not required, lack of authorization does not relieve the responsible party of financial obligation. And next, we're going to talk a little bit about what happens when the patient, or in this case, the responsible party is deceased. In this scenario, then an estate is filed for the deceased person. A lot of times it's typical that the estate may not have enough funds to cover all of the outstanding debts for that person. One thing to keep in mind in this case is children and other relatives are not responsible for the deaths of a deceased person. Children and other relatives are not responsible for the debts of a deceased person. That's a very important point. I've seen that show up on the exam a couple times, so definitely make sure that you drive that point home. But in a scenario where the patient is deceased, the following steps do need to be taken. You need to check if a legitimate estate exists and file a caveat to the estate. Check the register of wills for an estate. Make sure that the address that you have listed is updated to the estate of said patient and no longer the patient's name solely. And if there is no estate and no other party assumes financial responsibility, this is when you would go ahead and write off any self-pay balances after insurance adjudication has occurred. All right, so next we're going to talk a little bit about courtesy discharge. All right, so courtesy discharge is when the patient's financial considerations have been addressed. Courtesy discharge is allowed and allows the patient to leave the hospital without going through usual discharge formalities. And the patient is then go ahead and billed at a later date. There are a lot of advantages to this. Hospital-patient relations are improved. Traffic flow is greatly improved. You don't have everybody filing out all at discharge time, like check out at a hotel. So it improves that flow inside the hospital itself. It reduces the need for staffing, again, at those peak discharge times. And it allows for greater accuracy in billing. Anybody who's worked in revenue cycle knows that there are charges that get added or removed. There's hold periods that go on after the fact. And if we wait to bill the patient, a lot of those charges can be accounted for, and we're making sure we're getting the patient the most correct and up-to-date data on their statements. Okay. Next, third-party stalls and delays. This is when, if you're dealing with a third party, we've probably seen many examples of these, but there are tactics that a lot of payers will employ, basically to not pay or pay timely. And it's important to know these to make sure that we can go ahead and try to circumvent these and prepare as much as possible for them. Yeah, it's important during the credit collections process because it can make sure that we're improving our cash flow, which obviously keeps our facilities running, and it's reducing our revenue days outstanding, so it improves our metrics as well. Okay, so some of the common ones you might hear are, they didn't receive the bill. There's problems with coordination of benefits or MSP, Medicare Secondary Payer. Medical records are needed for review. Incorrect information was received. There is a missing or incomplete authorization. Timely filing is passed, or there's pre-existing conditions. These are just a few examples. There are many more listed in the manual. I would recommend knowing examples of these types of delays because those are things that usually show up on the exam. Okay, next talking a little bit about debt collection. When reviewing their collection efforts, an organization has a couple different options. They can either keep their collection efforts in-house, meaning they're doing them within their own facility with their own staff. And if that's the case, there's a couple of things they're going to have to consider. When assigning out accounts, they can be assigned by high dollars. They can be organized by payer, basically determining how they're going to tackle the workflow that they have. When preparing for your staff for collection efforts, you need to make sure that they're aware of all the pertinent information available when making calls and document everything. So doing a little bit of preparation before those calls, making sure you have all the information available in front of you. That's going to provide better information and make the process smoother. And as always, providing documentation with everything, usually inside your patient accounting system, so it goes into a system of record. When calling to collect, the primary purpose is to get the payment in full. That is always our goal, is you want to receive payment in full. Again, when preparing for the call, you want to go ahead and review the transactions that have been on the accounts, determine if there's been any previous efforts to collect. If you're calling somebody for the first time or the 50th time, it might make a difference in how that person receives the call, so you at least know what you're walking into. Make sure you're speaking to the right person, and also be aware if there is a minimum acceptable payment plan if you cannot collect the amount in full, so you can get that rolling as well. Also have to be aware of what's called the mini Miranda. And just like Miranda rights that apply to police officers, this is similar that when you are collecting a debt, you have to identify that this is an attempt to collect the debt. A lot of organizations, especially ones who deal in debt collection, will have, again, a preset statement put out for its staff and associates that they can use while trying to collect the debt. If a third-party debt collector does not provide the debtor with the mini Miranda disclosure, it is actually a violation of something we talked about before, the Fair Debt Collection Practices Act. So this is where that kind of circles back and applies to that. The other option we talked about, instead of going in-house, is you can actually utilize a collection agency. So there's a couple of things that have to be done if you're going to take that route as well. Medicare bad debt requirements have to indicate that there's an appropriate sequence of collection attempts before an account is referred to a collection agency. And there has to be a statement notifying the guarantor that they are being sent to the collection agency. As things get slightly more difficult to collect from certain patients, sometimes the only available option is to have a lawsuit filed against the debtor. This is typically done by collection agencies in this scenario. And there's a couple terms that we're going to need to know that kind of relate to some of those collection lawsuits. These are again included in the glossary of your book and are definitions that you are going to want to know. All right, the first one we have is judgment. Judgment is a legally verified claim against a debtor validated by the court. It's a legal right to collect a debt, and it can be used to obtain a lien, which is actually our next term. A lien is a recorded claim against real or personal property, typically arising out of debt. So here the creditor must be paid out of the proceeds of the sale if a property is sold. So if a lien is put against property, when that property is sold, then the creditor must be paid out of those proceeds. Okay, and the last definition term we have here is tort liability. And that is the liability for an injury or wrongdoing by one person to another resulting from a breach of legal duty. So if you're doing your paper flashcards or your electronic flashcards, those are three more that I would definitely add to the lineup there. Okay, next we are going to talk about skip tracing. All right, normally when we discuss a skip, we're referring to a debtor that cannot be located by the creditor. Skip tracing, is useful in the collection process. It's a way of helping to identify those missing debtors. And there's normally three types of skips when we talk about those. The first is an intentional skip. And that's someone who's avoiding paying their bills by changing their address or not providing a forwarding address. They could purposely change their name, or they could just straight up give false information to avoid paying those bills. So that would be the example of the intentional skip. There are unintentional skips, and that is someone who moves. doesn't notify their creditors. A forwarding address can be provided, but a lot of times it's more just, it's not done intentionally. It's something that, at least it just happens because of a failure to notify, not because they are trying to avoid paying a bill. And the last type of skip is a false skip, and that's a clerical error, usually done during registration. The address might be incorrect. Zip code could be incorrect. Some of the information might be incomplete. So when we refer to a false skip, that is what we're referring to. When dealing with skips, it's good to know the resources you have for performing skip tracing. Things you want to look at are your own patient accounting system. Does the patient have other accounts that have updated information you can utilize? There's also other resources such as the US Post Office, different internet sites that provide updated information. You can look at credit reports, current and previous employers, neighbors, and relatives. You do want to be careful though. If you are talking to somebody like an employer, a relative, a neighbor, you cannot discuss the details of the debt with those people. That's an area that can get some people into trouble. So you want to make sure if you are using one of those resources to do skip tracing, that you are not discussing the details of the debt involved. All right, next we're going to fall into the GAP and talk about some cashier functions. So GAP, of course, stands for Generally Accepted Accounting Principles. So another acronym. And these are the cashier functions that we're going to be discussing. So these include endorsing checks with for deposit only, issuing a receipt to the customer for cash payments and depositing them the same day, using separate cash boxes for cash collected and petty cash, store payments prior to deposit in a fireproof safe, maintain a duplicate number log and a payment log, lock the cash drawer and do not share passwords, and also separate the cash functions. Have one person responsible for collecting the cash, another responsible for depositing. When you have more than one person that takes over multiple of those functions, it becomes easier for creative accounting or other things that we would like to avoid to happen. So that's where the segregation of duties is important and can come into play. All right, and for the credit and collection section, there are a couple metrics that we are going to want to take a look at. The first one is going to be our average daily revenue. And that is the total revenue for charges generated over a period of time. So as you can see on the screen here, it actually gives you what that calculation is. So your total revenue for the number of days in the period divided by the number of days. So if there was, for example, if you're looking at a 3-month period, then let's just say January through March, the number of days would be the total of all the days in those months. So that works out to 90 days. So your first part of that, your total revenue or charges, that's going to be all of the charges that occur in that period. So if you're taking your January charges, your February charges, your March charges, and you're adding those all together, you're going to divide that by the 90 days that occurred in that period. And that is what's going to give you your average daily revenue. Okay. Our next metric is the average days of revenue in accounts receivable. And this can be known as ADRR, If you're looking at acronyms, which it doesn't exactly line up because there's an extra A in there, but you'll see it as ADRR in the manual. It can also be known as AR days outstanding, if you've heard it referred to differently inside your organization. It's basically an estimate of the days required to turn over the accounts receivable, and of course, under normal operating circumstances. So how long does it take to collect your accounts receivable? A good metric to have when working in credit and collections. So the formula for this is going to be your AR at a specific time divided by your average daily revenue, which is what we just calculated in the previous metric. So you'll actually have to use your knowledge of the average daily revenue to complete the calculation for average days of revenue and accounts receivable as well. On the exam for the CRCS, you do not actually need to perform the full calculations. They might give you an example that you have to be able to follow along with, but you won't have to do this along on your own. So you'll just, at this point, you'll really want to know the definition and the purpose of each of these metrics. And of course, just the general formula like we have written on the slides as well. Those are going to be some of your best steps to understanding those metrics and how they're going to appear on the exam. Okay, and that is actually going to bring us to a close for part 3, credit and collections. Next time, when you join us, we're going to be discussing patient access front office. And that will be part 4, and that will be the final part of our 4-part series as we're exploring the CRCS exam preparation. So thank you very much for joining us. We hope this information was again useful. And on behalf of Marina and myself, we hope to see you next time for part 4. All right, thank you.